Gopinath of the IMF. Gita, thanks very much for joining us on CNBC-TV18. It's good to have you back.
Thanks, Shereen.
Well, I noticed that you're on Twitter now, and did you feel the need for this? Because economic policy and foreign policy is now all sort of being dictated on Twitter.
I did feel like I needed to be on it. I held off for the longest possible time, so I'm a late entrant. But it certainly was a lot of important conversations
What's
happening.
the experience been like over the last 24 hours?
So far, so good. It's been fine.
Okay, since you're here in India, Gita, let's start by talking about India, and then I'll talk about the global economy. You've been meeting with government officials, you've met with bureaucrats as well. What's the sense that you get on whether we may have bottomed out? Is this the worst that we've seen as far as GDP is concerned? Because you're also on record to say that the fall in growth in India has been one of the big surprises, and that the IMF will also revise quite significantly its forecast for FY20 in January. Now, we've just seen Moody's put out its report on India, cutting the FY20 growth target to 4.9% versus 5.8%. So how significant is the cut from the IMF likely to be?
It has been a surprise. We were expecting a slowdown in the first two quarters of this fiscal year, and the expectation was that there would be a significant recovery in the second two quarters. Now, looking at some high-frequency indicators, we're not seeing that yet.
Okay.
And that is what is leading us to reevaluate our assessment that we put out in October. And like I mentioned, we will have a number in January, which will be a significant downgrade from what we reported in October. I don't have the exact numbers at this point, but January 20th is when it will be out. The authorities of whom I've met, who were very nice to give me their time, are working on the problems. They're thinking about it. Some of the issues are not very easy to solve very quickly. So, the issues with the banking sector, they tend to be long run. This is not just about India, but they tend to be long run more globally. In addition, in the case of India, there were certain institutions that did not exist that had to be set up. Right. So with the whole new insolvency and bankruptcy code. So then that adds further delays because there is uncertainty about how resolutions will work. There is uncertainty, and when you're thinking as a bank and you're trying to figure out whether you have adequate capital, you have to figure out what the value of your assets are. And if at this point it's unclear what the value is in terms of if it goes into resolution.
Right.
So there are uncertainties around that, and so you certainly see what looks like a reduction in bank risk appetite at this point, and that's showing up in slowing credit growth in India.
So would you worry then about consumption as well? Because so far the consumption side of the story has held up, and it's been the big problem has been on the investment side. Would you now be concerned about the consumption side of the story as well, given what you say about bank credit?
Consumption growth has slowed, and there are two factors to it. One piece comes from the farm sector, so rural income growth, and that has dampened consumption spending, and that's an important factor. A second piece is with the NBFCs that we're sort of financing for consumption spending, and that too, it hasn't cleaned up yet, and so that's a second source of the problem. Another important thing I should mention, the reason that this has been a bit of a surprise in terms of the growth numbers is that if you look at, for instance, business sentiment indicators, they held up quite well. And then in October, November, you saw a pretty steep drop in business sentiment. Now, that's hard to predict. And that's another feature of what we're seeing right now.
Speaking of, and you talk about this surprise, but the other surprise that people are also trying to grapple with, and the ordinary citizen is saying, look, if the economy is in poor shape, then how do we explain the stock markets, which are at record highs? Touching a record high practically every single day. What do you make of that? One explanation that we got from Credit Suisse yesterday was that 1/4 of the BSE 500 market capitalization is not necessarily linked to domestic GDP. So how do you explain this divergence that we're seeing between the macros and the markets?
So this is a phenomenon that's there in some other countries too. In the US too, though it's a strong economy, but if you look at the way the stock market is going, it's going to gangbusters. So there are two things that go into stock markets which can disconnect it from what's going on right now. One, of course, is a forward-looking variable. So the expectation of things looking up next year would give you reason for stock prices to go up. The second is the denominator, which is the discount factor, interest rates, borrowing costs, and with the monetary policy stimulus that's in the system, that has also reduced it. So the combination, and of course the third factor, which is there are firms that rely on external finance, external environment, and that can also play a role. But again, it is the fact that this is a more forward-looking indicator tells you that there is some optimism that remains.
But how do you then explain that in light of the fact that you yourself are saying that for FY20 the IMF is going to significantly downgrade the growth forecast?
The stock price is a present discounted value of the entire future stream, so it goes well past that.
Okay. Gita, let's talk about interest rates since you brought that issue up. And while we have seen the MPC cut interest rates by 135 basis points, and we have seen some of that being transmitted into the system as well, the view is that interest rates in India, given where nominal growth is, continue to be extremely high. What's your own assessment on that?
So there are two pieces to it. One is, like you said, there has been a significant amount of stimulus that's put in the system, 135 basis points. The pass-through in 2019 has actually been lower than in the previous years. And again, that is a piece that needs to be rectified. And next, in general, monetary policy works with lag, so you expect to see the effect showing up more in 2020. So there is significant stimulus in place. I believe, while on one hand you could say, we're looking at the economy, you would want to maybe have more stimulus in there. I think another important indicator to pay attention to is inflation expectations.
Right.
And inflation expectations have edged up, quite significantly in the last couple of months, and that could be a reason maybe to pause.
Which is what the MPC has done. But and I guess the RBI governor is saying very clearly that this is just a pause and they will evaluate on the basis of what perhaps happens in the budget, whether there is headroom now for the MPC to act further on rates. What would your expectation be, given the fact that we're already seeing this monetary stimulus? We've also seen fiscal stimulus by way of a corporate tax cut. What would be the expectation now in terms of other measures for fiscal stimulus? A personal income tax cut is what is being debated currently. Will that work? Is that necessary? What do you think?
I think it's very important for India to stick with its fiscal consolidation goals. The FRBM is an important target that the government should keep in mind and should work towards. If you look at the issues with demand in the economy, it's not government spending. In fact, if you look at the last couple of quarters, most of the growth has come from government spending. What needs to be revived is private sector demand, and that requires addressing these issues that are in the banking sector. I think that's an important piece of it.
So if you say that fiscal deficit, deviation perhaps is not warranted at this point in time, because again, the clamor to deviate, even whether it means going to 4% or, that's the expectation that the market is also working with at this point in time. Do you believe that, 0.5% deviation would be acceptable? Would that be necessary given where we find ourselves in the growth path?
I mean, from our point of view, we think it's very important for India to signal its commitment to fiscal consolidation. The borrowing costs are high. That would be one way of bringing borrowing costs down. So it has to signal that. Now, the details will matter about how exactly, the different pieces of expenditure is being assigned. But secondly, I think there's a lot of space for increasing revenue mobilization. Right? The GST revenue mobilization has not come in the way it was expected. So important steps in that direction would have to be taken to raise revenue mobilization.
Which means hiking rates or just better compliance?
That would require streamlining, better compliance, yes.
Okay, streamlining, you mean reviewing the rate structure that we currently have? Do you believe the current rate structure is too complex?
I think it would help to simplify it with maybe a couple of rates. But again, the details matter, and I believe it's being looked into pretty closely.
One of your former colleagues with Arvind Subramaniam, Josh Pellman, has put together this paper on the state of the Indian economy, as well as some recommendations on remedial measures to ensure that growth returns. One of the ideas there are two bad banks to address the real estate sector and to address the electricity sector, the power sector. Do you believe that, given the global experience, that is the way forward?
I have to look into the details of what they exactly mean by a bad bank. In countries that have done it, those usually apply to private sector banks. Now, some of the important issues are in the public sector in India, where 60% of the lending happens. So it's not obvious that that's going to be a solution for India. I think what is needed, which has already started, is a resolution of non-performing assets. What would help even more is if there was more infrastructure put in so that the resolution can happen at a much faster rate than it's happened. Debt restructuring of companies has to happen. One could think of bringing in more private asset reconstruction companies to get involved in this, more out-of-court restructuring. Those aspects are important. So typically when you think of, now of course there are some private sector NBFCs that one would think of as playing a role, but that requires expertise also in being able to value what those assets are. And the question is, again, the details matter. Is the private sector going to be involved in this? Or is it mostly a state asset company that's going to buy these bad assets? So the details, we'd have to go into the details before deciding on it.
Yeah, I would imagine that, yes, the details will be important. But let me then ask you about the view as far as the global economy is concerned, Gita. And the assumption is that, the US-China relationship on trade, it sort of looks like it's taking a step forward, and then suddenly one tweet will tell you that it's taken 2 steps back. For now, it looks like a phase 1 deal is in place. You can argue about how substantive that is, but how do you see that? Do you believe that this is a genuine move forward?
So we welcome what we say as a tentative phase 1 deal, because the details of it are still not known at this point, and it will come up sometime next year. Now, on the plus side, the tariffs that were supposed to come on December 15th did not happen. In terms of our projections for global growth, we assumed that those would be in place. So those coming off, and if they were to come off like in some sort of a permanent way, that would have the potential of raising our forecast by about 0.1 or 0.2% for the global economy. But again, a lot depends upon the durability of the agreement, that there is no further escalation towards other countries, that the trade tensions are not then compounded with technology tensions. So all of these aspects still matter.
But this is, of course, as you pointed out, something to be hopeful of, at least at this point in time.
Certainly, I would say compared to September, October of 2019, a few of those uncertainties that we were very worried about, I think are looking a little better now.
A little better. Let's then talk about Brexit, because that was the other sort of uncertainty that the global economy was grappling with. You now have a majority government in the UK, and Boris Johnson has made it clear that he's going to ensure that it happens by the 31st of January. Given the fact that the assumption is it's not going to be a hard Brexit, what would the expectation then be in terms of further upside revision to global growth?
The absence of a no-deal Brexit is very welcome. That's one of the risks that we've flagged. Now, we assumed that there would be that there would not be a no-deal Brexit, that there would actually be a deal. So our baseline already has the good scenario in there. So there's no further upside to it. Again, this, it still needs to be negotiated what the deals of the trade agreement will look like with the EU and with other countries. And that will take time, and that will play out over the next year. And those details will matter for if there's going to be any change.
One of the other sort of triggers that the world is grappling with is the scenario of negative interest rates that we're dealing with. How do you see that playing itself out, given where we find ourselves on the growth path?
Negative interest rates, people have analyzed this, and some of it works exactly as you would expect, that if you cut interest rates, and even if you're going to the negative territory, it stimulates demand. That channel does work. We have certainly seen employment rates go up in many of these economies. Unemployment is at record lows in the US. So there are positive effects that come from it. Now, of course, there are concerns that are rising with profitability in banks. Some of it actually we don't see. Bank profitability seems to be holding up through other ways. But then there's the other piece, which is a piece that we are particularly concerned about, which is financial risk buildup outside of the banking sector, the non-regulated sectors, because we've seen very high levels of corporate debt build up. And there are some countries that are taking macroprudential action, but several are not. And that's what we would flag for as long as rates stay this low.
Speaking of, the global outlook, what's the expectation now when it comes to China, outside of course, what's happening with the U.S. on trade? What about the debt issue that China is grappling with? What about domestic consumption for China? How are you looking at China today?
So China has taken major steps to improving its financial health with deeper financial regulation, trying to slow credit growth, and again move away from investment-driven, infrastructure-driven towards more domestic consumption-driven growth. But it's a $14 trillion economy. We expected not to be able to grow at 8-9%.
Yeah.
So it will slow. It is a structural slowdown, which is needed. And we're expecting it to be, at least in the near term, to be a fairly, a smooth transition.
A smooth transition. Speaking of the transition from being sort of domestic-driven to export-led, which is the aspiration that India has now put forward, this virtuous cycle that the government wants to create, which involves investment, exports, in order to get to that $5 trillion aspiration. What do you make now of this $5 trillion aspiration, given where we find ourselves with nominal GDP growth at almost 6%? How do you look at this, and how do you look at India's aspiration to be able to drive up export growth?
I think it's a very welcome aspiration. India will certainly get there. Now, the question is the speed at which it will get there. I mentioned the other day that it would require growing in dollar terms at 10.5%. And over the last 6 years, it grew in dollar terms at 6%. So this would be a serious acceleration. But again, it is a good aspiration to have. It would be really very good for India to be able to get more into the export space because it's not there. It's not a big part of global supply chains. We are seeing companies looking for other places to source from.
Do you believe the corporate tax reduction will incentivize companies to look at India more seriously from a manufacturing perspective?
It certainly makes India more in line with its peers in terms of the corporate tax rate, so that certainly is one plus. But in terms of actually having a bigger advantage, it would be important to get infrastructure in place. There is still, the connectivity between ports and factories, electricity availability. All of those features matter a lot for being a big part of the global supply chain. Land issues, labor laws, all of those matter. So, a tax cut alone is not going to be enough.
What's the global experience in terms of, the impact of a tax cut and how quickly that will lead to investment picking up?
It depends upon the environment in which the tax cut happens and what the source of, what demand looks like, what the environment looks like. It typically takes a little while. It's not something that jumps up immediately. So it can take, but we would expect to see the effect showing up in the next couple of years.
So as you look at at the global economy, the red flags that you're looking at, when we last met in Davos, Christine Lagarde, who's now, of course, with the ECB, said that she still believes that the multilateral framework will work. Given where we find ourselves today with the U.S. moving out of the WTO appeals process, for instance, do you still have hope that multilateral institutions will be relevant going forward?
I always have hope, so I keep my hopes up. Because that is, it's hard to think of a replacement for this. The world economy has had many years of prosperity. We've had big declines in poverty, global poverty, because of this system that's been in place. Now, of course, it's not perfect. It needs improvement. It has to address issues related to subsidies that countries' governments give their specific industries, intellectual property. All these aspects have to matter, but that just means that people have to work on it and come up with a better model rather than throwing it out.